Welcome everyone to today's Profit webinar, Business and Tax Planning for Tribal Enterprises and Individual Native American Farmers and Ranchers. This webinar is part of our Profit Risk Management series that includes webinars and in-person workshops focused on a variety of topics including food safety regulations, GAP certification, crop insurance, and risk management tools. If you look at the handout section of your control panel, you'll see a flyer that contains all the information you'll need to join any of the trainings in this series. You'll also find the slideshow being presented today that you can download and keep for later reference. I also invite you to visit our website at indigenousfoodandag.com, where you'll find more information about the Profit series and links to past Profit webinars. Once today's presentation is done, I'll unmute all attendees and we'll have a brief Q&A. After the webinar is complete, the webinar software will prompt you to fill out an evaluation for this webinar. If you could take a moment to fill that out, we would appreciate it. This series is possible with support from the USDA Risk Management Agency and the University of Arkansas School of Law Indigenous Food and Agriculture Initiative, who have joined with the Farm Credit Council and Morse Marketing to offer this important series of workshops. I'll introduce today's presenter, Poppy Davis, a small farm and ranch business consultant who will be today's presenter. Poppy Davis teaches and advises on agricultural business and policy issues affecting family-scale farms and ranchers and community interests in healthy food and farming systems. She worked 8 years at the USDA, most recently as the National Program Leader for Small Farms and Beginning Farmers and Ranchers. Previously, she was a California CPA with an emphasis in agricultural enterprises and nonprofits. She holds a Juris Doctor from Drake University Law School, a Master's in Journalism from Georgetown, and a BS in Agricultural Economics from the University of California at Davis. She has taught farm and ranch tax at the Crown Point Institute of Technology in Navajo and continues to work on Hopi with the Hopi Foundation and individual farmers and ranchers. Poppy, the presentation is all yours.
Thank you, Brian, and thank you, Janie, so much for inviting me to make this presentation today. I want to start with an overview of the topics we're going to cover. Brian, if you could, thank you. So what we're going to talk about today, we're going to come back over and over again to this idea of people, land, and activities, which is a framework for thinking about any agricultural business that you might want to undertake. And within that idea of people, land, and activities, we're going to talk about agreements between people, how decisions are made, how money and legal liability flow between people and land and activities. And that all comes under the heading of business entities, which we'll talk about in some detail. And that will set us up for a conversation about taxes. In this context, I'm primarily talking about federal income taxes. We're going to talk about a couple of other taxes as well, but we're really talking about federal income tax law. State law pretty much follows, but we're not talking about things like property taxes or sales taxes. Following that conversation, we're going to have an overview of accounting systems, the basics you need to know to start thinking about how to set up accounting systems so that you can keep track of the different parts of the business. And the final topic that we'll cover are a couple of special entities that might be of interest to some organizations, some individuals that are interested in working together, either through a cooperative or a not-for-profit or a membership association. Today, the learning goals, we're going to cover a lot. There's a lot of slides because we wanted to have them available to you with links for you to circle back to later. So I would advise the first time you listen to this or today while you're on the webinar to just focus on the big pictures and the big concepts and then take them and have conversations with the other people that you're thinking about working with. And then circle back. The materials will be available. Circle back at that point for a deeper understanding and to follow up on some of the details. So this is the basic concept that's going to drive this whole conversation. People, land, and activities. The biggest mistake that people make when they try to think about how to get something started is they see the people, land, and activities all mushed together as one thing. And that's fine and well when you're first envisioning what you want to do. But when you start trying to turn it into reality and make a business plan and set yourself up, you need to be able to separate the people, the individual people that are going to be involved, the exact piece of land where you're going to be doing this work, and the activities, or what exactly it is that you're going to be doing. So what do you want to do is an activity. Action, that's an active thing. Where you will do it on the land itself, alive and filled with activity, but it isn't your activity. Owning the land isn't really an activity. It's just you've identified the land, where you will do it, and the issues about that land we're going to talk about separately. And then the next piece is, who will you do it with, yourself or others? If you're doing it with yourself, that's one sort of an entity. If you're doing it with others, you need to know exactly what your agreement is with those other people. And most importantly, you need to know if you're going to deliberately form a new legal entity with written agreements, or if you're going to take your chances and have a totally informal situation. The land is the location where you're going to do it. This is one of the many ways in which farming and ranching are fundamentally different from other kinds of activities, like a typical consultant who can maybe work from a coffee shop or from home, and they're mostly just writing and talking on the telephone. The land is the anchor for land-based activity like farming and ranching. So you need to know, do you own the land? Are you planning on buying the land? Buying the land and owning the land is not the same thing as farming and ranching. And if you're thinking, and we'll move ahead in a while to talk about the cash part of it, but how you finance buying land and how you would finance operations on the land are completely different conversations. So that's why I want to underscore the importance of being able to separate out the concepts around the land from the concepts of the activities on the land. In a traditional situation, you want to ask if you have traditional rights to the land, if you have a permitted use of the land through the tribe, and if you're going to be paying rent to use the land or a permit fee. So on the activity side, what is it that you want to do? And that may be one or more activities, right? You could be farming and ranching. Your business plan describes your activities. The farm or ranch plan answers the question of what you will produce, and that plan is really going to be geared to the physical reality of what you can grow on that soil, or how many animals you can raise on that amount of grazing land, where you're going to sell those products, what price you can get for them. The marketing plan is related to the where you would sell and what price you're going to get, and it obviously needs to be tightly related to what it is that you're going to produce and how much of it you're going to produce. Can you sell everything that you raise? That's a lot of the question that the marketing plan answers. And then the cash flow plan is where you map out month by month the months that you spend money and the months that you get money in, and in most situations you're going to see that those don't line up. And that probably means that you either need to come into the business with savings, or you're going to need some kind of short-term credit to get over the months where you're negative. You need a plan so you can see those negative months coming and address them properly, and not wake up surprised one day to find out that you don't have money that month. An asset acquisition plan is a different kind of credit. Short-term credit for short-term cash flow shortages is not the same thing as long-term credit for buying land or equipment or building a facility like a barn or a packing house. You access the credit in a different way, and you need to bring different documents to get that credit. Finally, a business systems plan sounds maybe the least exciting, but that's what we're going to focus in on towards the end of this webinar. Setting up an accounting system so you can keep track of what's going on. Setting up a system for managing any paid staff, that's a human resources system. You're going to need systems for managing regulatory compliance. There's always some regulatory compliance, and you need to have your own system for how you document all those things. And then we're going to talk a lot today about income taxes, and the point really on income taxes is you need a plan for managing what that liability is going to be. So let's talk for a second about agreements between people. An individual might be a landowner, and an individual might be a manager or an employee. And a legal entity might be a group of people coming together to lease some land from an individual and hire some people as managers to do a certain activity. And between all of these operations, you have agreements, informal or formal agreements, about how that flows. And that's true, really, even if you don't recognize these as three distinct pieces. Those agreements are there implicitly, even if you haven't stated them. So the big point I'm trying to make today is you're better off to call those agreements out and have those agreements be the ones you want and not sort of the informal assumptions that you might have otherwise. So when it's just you, that is the most informal kind of entity. If you do nothing, you are just a sole proprietorship. You don't need to fill out any paperwork. You don't need to get any kind of business license. You may need those things locally, but in the big picture, and certainly for federal income tax purposes, as soon as you start working in your own for-profit business, you just are a sole proprietorship. In contrast, a single member limited liability company or corporation, you cannot form by accident. You'll have difficulty forming it not by accident. You have to fill out a lot of paperwork to form something like this. And the good thing about filling out that paperwork is in the process of doing that, you learn about how those entities work and why they're formed. When you form a business with other people, it is similar to the situation with a sole proprietorship in that you can actually form a partnership by accident. You can form a partnership just by working with other people and not really knowing about it. But you cannot form a limited partnership or a limited liability corporation or any other kind of corporation on accident. To form those entities, you have to deliberately sit down and figure out exactly what your agreements are between all the different people that you're working with. A tribe can also form a governmental entity to perform a business function. So that's a little bit different than the options that individuals have. So what are business entities? Again, an informal business entity can be formed basically just by starting to work. In the case of a sole proprietorship or in the case of a partnership, it's formed sometimes accidentally as soon as people start conducting business activities together. The key characteristic of these informal business entities is that because they're informal, they're not really separated from the individuals. Any liability incurred through the business goes all the way to all the personal assets of the owners. So what I mean by a liability here is if the business does something wrong by accident, not necessarily on purpose, maybe someone's driving a delivery and they're too tired and they fall asleep at the wheel and they hurt someone, that is a business liability. And if you're not incorporated as some other kind of entity, you yourself and your partner, if you're in a partnership with someone, you're personally responsible for the damages that that accident caused. In contrast, if you incorporate a formal business entity, one of the very first things that happens is that you limit that liability. So in the same situation where someone is driving too tired and they get in an accident and hurt someone, the damages, their legal responsibility for making that right is limited to what's in the business, the assets of the business. We're going to talk towards the end in the accounting section about what we mean by the assets of the business, but for simple purposes, we're talking about the money and equipment that the owners put into the business. And again, why we're keeping the land separate is the land would not be included in that if you're properly set up, and we'll talk about that more in a minute. The other important thing about forming a business entity is that you come up with formal agreements about when owners put money into the business if the business is short of money, or when they can take money out of the business. And you will find as you get into business that these are two of the most important things for helping the business succeed, because if owners disagree, about when they need to put money in or when they can take money out, it can cause cash flow problems in the business that can bring the business down. So the big question on business entities, particularly if you're thinking about doing business in Indian country, is what law governs. So there's federal, state, and tribal law could all affect how your business entity is structured and how it's governed. So tribes, under federal law, tribes can form what's called a Section 17 tribal corporation. That's rare. Most all other kinds of corporations are formed under state law. But this is a special entity that allows tribes to separate corporate assets and liabilities from their government functions without putting the corporation under state law, which might not be desirable. So generally, the Section 17 tribal corporation has the same sovereign immunity and tax-exempt status as the tribe, but it's separate from the tribal government itself. Most businesses, though, are formed under state law. State law is the script for how the liability flows through that entity or does not flow through that entity. And it's the script for the default agreements between the owners. So are good. But if you forget to put something in your agreement, state law is the default, and so that's one of the functions it serves, is it answers those questions for you if you haven't answered them for yourself. Federal law will still govern how federal taxes are reported and paid, even though the entity itself is formed under state law. Some tribes have adopted laws to enable the formation of tribally chartered for-profit corporations. In those cases, immunity and tax status will depend on the circumstances, and it's important to note that this is an unsettled and changing area of law. It's going to be different everywhere you go, so that's where you're really going to need individual advisors who know about where you are specifically. There's a link here also for more background information on tribal business structures. So again, key things about forming business entities is thinking about how decisions are made. The partnership or incorporation agreement should specify how decisions get made, and if it doesn't, then the governing law will decide. And the governing law, that's why it's so important to know what the governing law is, if it's federal, state, or tribal. So this leads us to how you're going to be taxed. So again, I'm talking about federal tax. This is a situation where the federal tax depends on the type of entity you form. Even though you form that entity under state law, it affects how you're taxed at the federal level. State tax generally follows federal tax. For most people, taxation is the single most important consideration in choosing which type of entity to form. We'll talk about that more when we get to the tax section. Other kinds of agreements between people, we're not going to cover these in detail today, but just for you to think conceptually about how to keep returning to this idea of the triangle between people, land, and activities. So other kinds of agreements between people are employment contracts, land rents or lease payments, which go with the right to use the land, contracts to sell or buy, and contracts for services. So owners and employees. Owners at some level have invested capital. That means they have put their own assets, meaning cash or equipment, into the business. And what they get in exchange for that is they get back out of the business some share of the profit or the loss. Often owners do not get paid. They certainly don't get paid a regular salary unless they're formally set up as an employee. And owners can be employees, but they're not automatically employees. Employees, in contrast, are protected by federal employment law. They must be paid at least minimum wage. They must be paid regularly. The employer must withhold certain payroll taxes, and the employer must pay payroll taxes and workers' compensation insurance to protect the employees. The employer also has to comply with other health and safety laws to protect workers. Contractors are neither owners nor employees from the perspective of the business owner. From the perspective of the contractor may either be the owner of their own company or the employee of a company that your business has contracted with. But contractors don't fit in from your business perspective. They're neither owners of the business nor employees of the business. Really important not to try to pretend that employees are contractors. It's a very common mistake people make. They think that they can get away from paying the payroll taxes and the workers' comp insurance by sort of saying that someone is a contractor instead of an employee. The penalties for doing that are very steep. They're very deliberately designed to make it much more expensive to make that decision than to make the right decision. The right decision is based on several different tests. Those tests are mostly centered around the idea of how much control you have over when and how an employee's work is done, as opposed to an independent contractor, which is mostly seen as someone who has a lot of discretion in how they do the work. You're just paying them to have a certain thing accomplished by a certain time. So let's look at land again. Remember in our triangle, so we've talked about people and the entities. Now we're talking about land. So land can be owned, it can be leased, and you can have a permit to give you rights to use the land. You can form a separate business entity just to own the land with the others, but you don't need to. Default law allows people to own land together without creating a separate business structure. Important to understand this distinction. When you do a business activity with other people, you may accidentally form a partnership, but when you own land with other people, you can do that without forming a separate business activity because land ownership itself is not necessarily active. If a person is going to be on land that they don't own, then they need something to show that they have legal rights to be there. That's typically a lease or a permit. In the case of a lease, there's going to be some sort of a rent payment. Often in agriculture, there's what's called a crop share payment, where there's an agreement rather than paying rent, when the profits from the crop come in, those profits are shared between the landowners. That sounds a lot like an activity. That sounds a lot like a partnership. That's just sort of a specific area of law, one of many, where farming is given favorable treatment over other kinds of activities. And people use these crop share payments more like leases than like active businesses. The other way to have legal rights to be on the land is to get a permit and to pay a fee, which is similar to rent payments, to have that permit to be able to be on the land. So typically, land is not owned by the business. That's my point of the triangle, keeping the land ownership and the activities separate. Why is typically land not owned by the business? Goes back to what I said a few minutes ago about protecting in the event of some sort of a bad thing happening within the business, someone's asleep at the wheel, someone gets badly hurt, the business needs to make that right. It could take every dollar of cash out of the business. It could take every piece of equipment out of the business. It could take all the crops and all the animals that are in the business could all go to pay for the harm that was caused. But if the land isn't owned by the business, then the land can't be used to make that payment. So it's a way of protecting against something really bad happening in the business. But it only works if you have an actual agreement and you actually pay the rent. You can't just say it's separate when it's not actually separate. You need to demonstrate that you're really keeping the land separate from the business, and you do that by having a lease agreement and actually paying rent. Often people are short of money and they do what's called swapping checks, so the business will pay the rent to the owner and then the owner will turn around and put the money back in the business. That's fine, but you do need to go through those steps. So let's focus specifically on Indian lands and different kinds of Indian lands and how that might play into how we think about setting up a business. So trust lands are controlled by the tribe or by individual Indian people. The title is held in trust by the federal government, and most trust land is within reservation boundaries, but trust lands can also be off the reservation. Tribally owned lands are owned by a group of Indian people recognized by the federal government as an Indian tribe. While this matters is going to come up in a minute when we get towards taxes. But for more information about how to understand the different kinds of land ownership on Indian lands, the Indian Land Tenure Foundation has many, many wonderful resources. So allotments are a different kind of Indian land. They may be restricted fee lands where ownership is the same as if you had bought the land outright, but there are specific government-imposed restrictions on the use of the land. And we'll see later in the tax section, there are specific tax benefits that can come from being on these specific kinds of fee lands. And the right to use and transfer the land may be subject to approval from Tribal Land Office or BIA. That's where the permit comes in. And we'll talk about that a little more later. If you want to access certain federal programs, you may need to demonstrate that you actually have the right to be on that particular piece of land. Allotted land, that's generally reservation land that the federal government distributed to individuals, generally in 40, 80, or 160-acre parcels. And an allottee is the individual who owns the undivided interest in that allotted land. This will be very important again when we get later to the tax section. So finally, fee lands are lands that have been purchased outright or acquired by the tribe or the individual. The ownership of the individual is complete. They don't have to get approval for decisions about the land. Another important thing to mention is fractionated land, which is fee or allotment land that has been passed down to multiple generations of heirs without a will. So when one person dies and they leave it to 4 children, and then each of those 4 children die and leave it to 4 children each, pretty quickly you can have many, many owners on one piece of land. If you want to then one person start using that land, or even just a couple of people within the many people who own the land, they have to come to an agreement with all the owners about how that land would be used. And obviously that's very difficult. There are some rules for how a small group can regain control of that land, but how many owners have to consent to a particular use depends on how many owners there are in total. As I mentioned before, USDA programs can be an important way to build or maintain a farming or ranching business, but they're going to require you to show that you have the rights to be on that piece of land. So that would affect if you have highly fractionated land and you're just one of many owners, you wouldn't be able to show the USDA that you have the control of the land, and so you might not be able to participate in the program. The type of approval you need depends on the type of land that you're trying to use. So you might need tribal government approval or BIA approval or approval from the co-owners. But you're going to need something to show that you are the person that has control of that land. And some USDA programs require proof of filing a Schedule F or something similar to that as a way to access programs. And that's part of why we'll talk about the tax returns in detail. So for more information on how you go about getting control of your land and showing that control of the land, we've listed here a number of different resources for how you can get more information. This is obviously a difficult and complex area, so we're not going to go more into it today, other than to really underscore that when we talk about people, land, and activities, we're talking about the land here, and that in and of itself is going to be a fair amount of work to make sure that all the things you need to know about the land are known and squared away and properly documented. So let's talk about taxes now. So this is kind of going back to the people part, how people come together as entities. Taxes are in great part driven by what kind of an entity you choose. Other kinds of taxes are based on the land use itself, so that's taxes that relate to the rents and royalty payments. And then finally, some taxes are based on the types of activities. So operating a business, an activity, is different from receiving rents and royalties. And a gain or a loss from selling an asset is different from a net profit from the activities that you do day to day in a farming business. So we're going to walk through all of those in a little bit more detail. So first of all, sole proprietor, we said that's the simplest thing. You just start into business, and then when you get to the end of the year, you report that activity on your personal income tax return, and you pay the income and self-employment tax associated with that activity. And we'll talk about that some more in a minute. Partnerships, S corporations, and some limited liability companies will report the activity on a business tax return. That's a separate tax return from the tax return in individual files. And the income is going to pass through that business tax return to the individual owners. And then the individual owners report and pay taxes on their part of that income. We're going to go through that in a lot more detail in a few more slides. So this is just your first pass at understanding that. Other kinds of corporations report and pay taxes on a business tax return. So the types of taxes based on land use or activity type. On land use, rent income is what's considered passive income. So it is subject to income tax, but it's not subject to self-employment tax. Self-employment tax is based on your actions, your activities. Royalty from mineral extraction is also considered passive income, and it's subject to an income tax, but it's not subject to the self-employment tax. Net earnings from business activities are the difference between the income from that activity and the expenses needed to generate that income. That's considered active income, and that's subject both to the income tax and self-employment tax, depending on how the entities are structured. So I know that was a lot to take in, and that's why I'm going to go through it all again now with pictures. So let's walk through some more how this looks. So income derived from the land is only a concept on different Indian lands. That's why we talked about the Indian land before. For some Indian lands, income derived from the land, which is farming, ranching, hunting, fishing, and mineral extraction, is completely tax exempt. But the land has to be that special type of Indian land, and the person claiming the exemption has to be an enrolled tribal member. So here's the rule. There it is. I didn't write it. Internal Revenue Service rule. It will recognize exempt status of income received by an enrolled member subject to 5 tests. The land in question is held in trust, restricted and allotted. The income is derived directly from the land. We're going to talk about that more. And then the most important and most difficult one for you to get an answer for yourself is the statute, treaty, or other authority shows the congressional intent. And that authority has language indicating that intent, that the land is not subject to taxation. So the first 3 things you can probably figure out pretty easily on your own. The second 2 you're probably going to need help knowing. So income derived from the land is income from farming, ranching, hunting, fishing, mineral extraction, and it's also lease payments and rents. Depending on the individual tribal treaty or the individual allotment act, that's what decides if this income is tax exempt. The only way to know is to know what it says in the tribal treaty for the trust land or what it says in the specific allotment act that created the allotment. And there were many different allotment acts, so you can't assume that if it says it's tax exempt in one allotment act, it applies necessarily to your piece of land.
So, Poppy, this is Janie. Hello, everybody. This is Janie. I wanted to weigh in here and first of all, thank Poppy for being so willing to do this webinar. Her information always blows me away. But on this particular point, I wanted to weigh in and just let folks know we've done quite a few tax trainings in the past and been involved in a couple of publications There's a difference between what is generally accepted sort of out there in Indian country as what we think we know the law is, as to individual farmers and ranchers, and what the actual state of the law is. A lot of these areas that Poppy just went over haven't really been fully clarified even by the IRS. And so sometimes we hear of people who get caught up in situations where they get audited and have not filed at all, but have ongoing farming and ranching operations. It can really put you behind the 8 ball, so to speak, and it can put you in a position of where you're having to decide whether you're going to take on the IRS to fight these issues of whether or not whatever you've done is income derived from the land or would meet all 5 of the critical points that are in the what little guidance we have at all in this space. So, you know, as a lawyer, and I hope Poppy would confirm that I'm not just talking outside the boundaries, but you really got to have local folks who you search out, and they are out there, not very many of them, but they are there, to kind of help you in this whole tax treatment situation. If you are farming and ranching on any particular types of property that might kind of pull you into this exemption for income derived from the land. A lot of folks run their animals, for instance, on trust land and then fee land, and then it's just whatever is available for you to actually use you know, within your reservation boundaries. So it can get very complicated very fast, and what we think we know about this is not truly what the state of the law is. So I just wanted to weigh in here just briefly, kind of put an exclamation point behind this. There's a lot more work to be done in this particular area so that we can help native farmers and ranchers grow their operations over time, but also stay out of the scrutiny of the IRS, because that is, I think, everybody's goal, no matter whether you're farming or ranching or whatever other kind of business you're doing. So I just wanted to weigh in and let you know that we're totally open all the time to accept questions and really kind of help people walk through some of these issues, but just know that this is an area that's not fully fleshed out.
Thanks, Janie. Let's go to the next slide. Thank you. So this is the IRS's language. It says it must still be reported. Janie's point here is that just because the IRS said it must be reported, that's not final law. That's final law relative to most of us on most days, for sure, because fighting the IRS is a big undertaking. But to Janie's point, it could, in theory, be contested, and that IRS decision that it has to be reported in this way could absolutely be ruled against at some higher level. So I want to also challenge you with some questions about exempt income. So is it a good thing? Since income derived from the land is exempt from taxation, losses from the same business cannot be used to lower your taxable income. So I have a little chart here that shows what happens if you have $30,000 in wages and a $10,000 loss from ranching. If it is exempt income, if you're treating it under the privilege of the exemption, you cannot take that $10,000 loss to reduce your $30,000 in wages, and your taxable income is still $30,000. But if you're not eligible for the exemption, or if, and this is again unsettled law, exactly what you're able to do, but if you don't use the exemption, you would deduct the $10,000 and you would only pay tax on the $20,000. So you can see that that's a significant difference in outcomes. And again, somewhat unsettled area of law. It's clear if you're not entitled to use the exemption, you can't use the exemption. But it's not clear if you're entitled to use it, if you can elect not to use it. And that's an example of what Janie's talking about, where you really need to get local and expert advice. Other very important issue to understand is that the current way that the IRS interprets this rule is that income that is exempt cannot be included in the base income that's used to calculate the earned income credit. So just like on the prior slide where you combined your wage earnings with your self-employment earnings to get your total taxable income, when you're calculating the earned income tax credit, you combine wage earnings and self-employment earnings to get that base that's used to calculate the earned income tax credit. And for some people, the earned income tax credit goes up as income goes up for a while, and then the earned income tax credit starts to go down as income continues to go up. So it's a little tricky to know how to get the most of that earned income tax credit. Sometimes it goes up with more earnings, and sometimes it goes up with less earnings. The point is that if you have this exempt income derived from the land, you cannot, according to current IRS interpretations, you can't use that exempt income to increase or decrease your base for purposes of getting the earned income tax credit. Again, the issue of reporting, the IRS position is that you need to report it. Other positions based on sovereignty and other issues are possibly completely legitimate, but it's completely unsettled, hasn't been addressed by the IRS or by higher courts. So this is really, I'm not going to read this slide. This is what Janie said, that this is an unsettled area of law and something that you want to proceed carefully. But you know, our goal for you today in bringing this issue up is that you know there's an issue here and you get local advice before you proceed. So this is the part where I'm going to walk through taxes again with pictures. And this is the part where I'm hoping you'll have some understanding of why these different entity structures matter so much. And again, if you don't get this all in one pass, that makes you completely normal. But the pictures are here, and you can go back a few different times until you do understand it in a way that's meaningful to you. So here's the basic tax formula for an individual. You file a Form 1040. You report your W-2 wage earnings, that's earnings from a job. The Medicare and FICA portion of that tax, that's not an income tax, that's a different kind of tax, has been withheld and paid by your employer. Half of that came out of your check, that's why you see your net paycheck is so much less than what your total earnings were. And then half of that is paid by the employer. When you're self-employed, you're both the employer and the employee. So you have to pay both sides of that Medicare and FICA tax, and that's called self-employment tax. So self-employment tax is calculated on non-farm self-employment earnings, which is a Schedule C, and on farm and ranch self-employment earnings, which is a Schedule F. In addition, pass-through income that comes from certain kind of entities, and we're going to talk about these in great detail in a minute, but if you form a certain kind of partnership or certain kind of S corporation, income may flow through that entity, not be taxed at that entity level, and come to you, and you pay the tax at your individual level. That may include rental income, it may include active income that's subject to self-employment tax. So we need to have a lot more understanding of which kinds of income are subject to the self-employment tax and which kinds are not, and that's what we'll be talking about for the next several slides. Other kinds of income that you'll report as an individual would be dividends and interest, which are not active, capital gains, also not active, and then pension, retirement, and other kinds of income. So those are all incomes where they just go into calculating your tax base for income tax purposes. Self-employment tax is an additional and separate tax in addition to income tax. So that's why we have to keep going back and highlighting and asking the question, is this self-employment earning or is it just regular earning? So pass-through entities are different. Remember I said you can't really do this on accident. So if you have a partnership, you're supposed to file a separate tax return for that partnership. If you form an S corporation, you file a separate business return for that S corporation. It's a Form 1120. A limited liability company is a little bit of a hybrid, but it elects under federal law, it elects if it's going to be taxed like a partnership or like a corporation. So for tax purposes, we're only going to talk about the 1065 partnership return or the 1120 corporate return, because the LLCs will fall under one of those two things. What we mean by a pass-through entity is that, could you go back, Brian? Thank you. The entity reports the income and the expense, but does not calculate or pay the tax. And then the net taxable income passes through to the owner. So the net taxable income is reported to the IRS and to the owners on a K-1, which is similar to the W-2 that you receive from your wage earnings. And then when the owner files a 1040, they report that information. You can go to the next slide. So the idea of the owner reports and pays, the entity reports but does not pay. Really important to get that distinction so that you don't think you're paying taxes twice. We're going to talk about certain entities that do pay taxes twice, but the key thing on these pass-through entities is that although you report twice, you only pay once. Go ahead. So the other important thing to keep in mind, and I mentioned earlier about the importance of tax planning so you know what's coming to you. Net taxable income, what gets reported and paid on your tax returns, is not the same as the actual cash that passes through to the owners. They can be really, really different numbers. And we're going to talk a little bit about that in the accounting section, but not in detail. I'll just say that this is an example of why you need a good accounting system so that you have advanced notice for yourself of the difference between the cash payments that go out to the owners and the taxable net income of that business entity. Because the owner is going to be paying tax on the taxable net income of the entity, regardless of whether or not they got cash out of that entity. And it's a very common situation that especially in the first years of a business where owners aren't used to how this works, they end up with a tax bill and they don't have cash to pay that tax bill because they didn't do adequate planning and they didn't see it coming and they didn't take enough cash out of the business to cover that tax bill. Go ahead. So let's talk again about active and passive income, because this is where it becomes important to think through again the difference between the entities, the land, and the activities. So for an entity, the taxable income from business activities flows through to the owners, and the land rent flows through to the owners. But the income from business activities is subject to that self-employment tax, and the income from the land rent is not. So if you're an owner, that income from the land rent is better, right, than the income from the activities because you're going to pay less tax on it. Doesn't mean that you're free to jack up your land rents to avoid this. You can't have a rent agreement that's really more than what the fair market rate would be. But it certainly does mean that you can free some income from this 15% self-employment tax by having it passed to you as land rent, provided, of course, that you are in fact the owner of that land. So again, this is just another way of looking at the same triangle, always going back to break it down this way. Between the entity and the landowner, we have rent, which is passive income to the owner, and between the entity and these active activities, that's where the active income flows through. So let's talk for just a minute about double taxation entities. I'm just going to make you aware of them so you won't form one, because usually small businesses don't choose to go this way, and this is why. When you have a C corporation, and the C corporation is the kind of corporation that you hear about on Wall Street. That's the kind of corporation that if you have maybe savings in a retirement plan and those savings are invested in different stocks of different publicly traded corporations, That's what we're talking about when we're talking about a C corporation generally. You can form a small C corporation, but usually people don't. And this is why. The corporate tax is paid on net earnings, period. Whatever the net earnings are, that's where the corporate tax is paid. Then after that, cash or dividends may come to the owners, and that's where you get your interest, say, in your retirement plan. You get dividends from those investments. That comes to you, but that's after the tax is already paid at the corporate level. So if you're the owner in this situation, if you're the owner of both the corporation and you yourself are receiving the income, you're going to pay tax at the corporate level, then you're going to get the dividend income, and then you're going to pay income tax on that dividend all over again. So that's not a great situation. Next slide. So this is why we have S corporations. So S corporations are a special kind of tax corporation. So they're all corporations sort of in terms of your documents to create the limited liability and to get yourself set up with the state. But from a tax purpose, from a federal tax purpose, an S corporation has this very specific quality that it allows you to deduct the salaries and rent paid to the owner from that net income that passes through. So the owners get their salary and their W-2 earnings with those payroll taxes already paid, and they don't have to pay payroll taxes, or self-employment taxes rather, on that earning. It was already paid at the corporate level, and it was already deducted from those corporate net earnings that pass through the owners. And then in addition, the owners can also still get the rent income. But the important distinction here is to move, to separate the amount that the owner gets into the portion that the owner gets as an employee and the portion that the owner gets as an owner. The portion that the owner gets as an employee is subject to payroll tax. The portion that they get as an owner will either be active or passive depending on many other circumstances related to the S corporation, and that's an example of where you would again be in conversation with your local advisor to walk through the details of this structure. So that was a little bit about structuring entities. Here's another big concept that really affects how all of this plays out, and that is the definition of income from farming and ranching as opposed to other kinds of active income. So farming and ranching income is subject to more favorable tax and accounting treatment than other kinds of income. So we need to look at the tax definition of farming and ranching income to know where to draw that line. This applies to general tax law, but it also is extremely relevant to the definition of income derived from the land that we discussed earlier. So in this case, for income derived from the land, it's not just more favorable tax accounting treatment, it's full-blown exemption. So farming and ranching activities end when the product is in the condition in which it is usually saleable in the region. That is not a really bright line rule, so let me give you some examples. Processing an agricultural product beyond basically cleaning and packing it needed to safely transport it to the first point of sale. Anything beyond that is generally considered a value-added manufacturing activity. So fruits and vegetables are usually sold cleaned and bunched, boxed, or bagged. They are not sold as jams and sauces. You don't need to make them into jams and sauces in order to sell them. Milk is typically sold as a fluid. Whether or not it's in the bottle is a little bit something that you could argue, and that's local, case by case, but for sure you do not need to make milk into ice cream or cheese in order to sell it. So there's no question at all, that ice cream or cheese would be value-added manufacturing activities and not farm activities. Meat animals are generally sold live or as half carcasses or whole carcasses or broken down into primal cuts. Some questions there, some legitimate questions about exactly where the farming activity would end on meat animals. But there's no question that something as highly processed as a sausage, a ham, or a jerky would qualify as farm or ranch income, because those activities are clearly beyond what is necessary to take that meat into a state where it has a market at somewhere in the area. You can sell meat either in the carcass state or broken down into primal cuts. You don't have to make it into sausage or jerky in order to find a market. So what do you do about this? What does this mean? Income and expenses associated with value-added manufacturing activities are not farm or ranch income and expense. So in the case of a sole proprietor and a partnership, you don't report that income expense on your Schedule F. And therefore, that Schedule F without those activities is all you can use to qualify for programs that require a Schedule F. Other entities report their pass-through farming income on a K-1, and on that K-1, if it's done properly, and it's not always done properly, but if it is done properly, there's a footnote notation on the K-1 that says of that pass-through income, how much of that is qualifying farm and ranch income, and how much of that is other self-employment income. And you would use that notation on the K-1 to know how much of that income would qualify for programs requiring a Schedule F, or in the case of certain Indian lands, how much of that might qualify for the exemption. So important to recognize that this kind of income wouldn't qualify for income derived from the land, even if you had met all the other requirements for the underlying farming and ranching activity. So now we're going to talk about accounting. I think that what we've talked about so far on taxation, and I know it was a lot to go through, and I have zero expectation that anybody fully now is ready to go out and understand all of that and repeat it to other people, but I think what it shows you is that you're going to need an accounting system to keep good track of things, right? So let's just take a preview at what goes into having an accounting system so you can start thinking about how to build an accounting system as you build your business. So we're going to look at systems, structure, procedures, and most importantly, I think, how to get help. So on accounting, the idea is to set it up with your goals in mind. Don't ever leave the driver's seat of your own business. Why do you have an accounting system? It's really not because Poppy and Janie said so. It's really because if you're farming and ranching with other people, you need some way to maintain that trust between everyone, and you're never going to be able to have that trust if you don't have really, really clear statements of where the money's coming from and where it's going to. Even if you're farming on your own, you're never going to be able to manage your land and your activities intelligently if you don't have records of what you're doing, where it's coming from, where it's going to. Maybe you're farming so small with so little money that you can keep it all in your head, but probably not. Probably you need records. How are you going to look ahead and decide if you need credit? Very hard to keep all that in your head. A decision about if you can afford to expand. You have an opportunity to lease a whole nother piece of land. Is that a good opportunity or a bad opportunity? Is that going to end you up with more income or less income, more cash, less cash? Maybe it's good for your tax position, maybe it's bad. You don't know if you don't know how you've been performing on your other lands, and you can't make any projections about how you might perform on that new land. Finally, you need the accounting system in order to make decisions, in order to actually file your tax return. I did put that last because while filing tax returns is an absolute requirement, you shouldn't have it drive your accounting system. What you should drive your accounting system with is your desire to be a good manager, and then let the tax decisions flow out of that. One of the things you're managing is taxes. So let's just talk for a minute about accounting systems. Everybody kind of wants to jump up and get something in place. Most people now are pretty excited about low-cost software that you can buy in any office supply store. very user-friendly. My mom used to say, if you can read, you can cook. And so I tell people, if you can read, you can use QuickBooks. It's very point and shoot. But that doesn't mean you're going to be a good cook just because you can read, and it doesn't mean that you're going to have a great accounting system just because you're following the point and shoot of some of these low-cost accounting programs. Truthfully, manual systems are great. They teach you a lot more accounting. You actually have to understand what you're doing. But there is repetition in just writing things out, and most people today are frustrated by having to do things by hand when the computer can keep it in a database form so much more effectively. But I wouldn't discourage anyone who's drawn to the idea of a manual system. There are some really good manual systems out there, and of course until the 90s everybody was using a manual system and they were doing just fine, and I would argue in many cases they were doing better, because the low-cost software can really leave you with the impression that you know more than you really know, and a manual system, it's much harder to fake it. Like, you know when you have questions and you have to get those questions answered, and then you can go on. There's expensive software out there, but that's really, you're never going to run into that until you're at the level of a large corporation or a large tribal enterprise. So what you need, again, depends on the size and complexity. I'll go ahead and say QuickBooks is the one that most people use. I'm not making a brand name endorsement. That's just the one that's out there that most people are using. Big advantage of it is it's easy to hire someone who already knows how to use it. And if that person leaves and you need to hire someone else, there's someone else you can hire pretty much any day of the week who knows how to use it. So that's a huge advantage. It can absolutely handle most small and mid-sized businesses. There's absolutely enough data capacity in that program to handle quite a bit of growth, quite a bit of complexity in your business. But it does have real limitations, and what I would say is you'll know it when you get there. You don't wake up one day and form a business with so much complexity that you've already maxed out QuickBooks. You start a business on QuickBooks, you grow and grow and grow, and slowly, slowly, slowly you start to realize that you can't get quite the reports you want. And that's when you think about upgrading to a little bit higher end system. There's quite a few mid-range systems out there that are really, really good for more complex operations. But again, you know, you never start out at that level, and you will know when it's time to start thinking about it, because you'll start feeling the lack of reports that you need. And that's going to mean you're being a really good manager, because you're asking for more detailed reports. Again, the high-end systems, way beyond where anybody starts out from. They're really at the level of a healthcare center or a tribal government unit or a college or something like that. Let's talk about what we mean by an accounting system. So this is the structure of the accounting system. It doesn't matter if you're on a manual system or a high-end or a low-end system. It's all a different way of building a database around these basic concepts. So a balance sheet is a listing of assets, which are things you own, cash, equipment, land, and liabilities, which are things you owe, generally accounts payable, so routine amounts that you owe out, and debts, more formal, longer-term loans that you might owe. The difference between assets and liabilities is called net assets or equity. Equity is the common term used for an owner, but net assets is a little bit easier maybe to think about just mathematically. Assets minus liabilities equals net assets. That's your equity. On the other side is the income statement. Income is the money that comes in from your activities. It's not the same thing as gifts. It's not the same thing as loans. It's income that was generated from your activities. And expenses here are the expenses that were ordinary and necessary to generate that income. So again, when you pay back a loan, that's not the same thing, because paying back a loan isn't the ordinary and necessary part of generating that income. Paying back a loan is up on the balance sheet side, where you're just reducing that liability. What we mean by expenses are things that are tightly associated with generating income. And another way to think about it is if you have two identical ranches side by side, and one ranch had a ton of money going in and they pay everything cash, and the other ranch borrowed everything in order to run that ranch. You shouldn't have to really consider the source of that money when you just want to look at who's running their ranch efficiently day to day and compare income off of an acre and expenses off of an acre between two ranches that are side by side. If you keep that income and expense concept clear, that it's what's directly associated with the business, then how the money gets there, the assets and liabilities section, that's more personal to the owners. And income and expense is more of a management concept about daily and monthly operations. So the reason I give you that structure is because when you set up your accounting system, you need to understand those differences so you can set up all the different categories of assets, liabilities, income, and expense. So under assets, you're going to have a section of your accounts that you set up, and you're going to list your bank accounts. Each of those will get a specific account listing. Accounts receivable, it's usually one account, but within that one account, you would have individual records for all the different people you sold to who owe you money. And then another kind of an asset is equipment. So if you buy cars or tractors or things like that, those are all assets, and you need a separate account where those assets live, because that's different again from expenses. And we're going to talk about expenses in a second. Liabilities are the amounts you owe. So liabilities are individual accounts payable, which is bills that come in, bills that you have to pay for things that you use up pretty quickly, and then loans payable. So that's any credit that you received. It's an asset in the sense that you have the money in the bank, but it's a liability in the sense that you still need to pay it back to the person that made you the loan. Income and expense we discussed. The income, we're talking about only what's associated with the products that you raised, and it can also be some government program payments that are, again, tightly associated with that farming or ranching activity. And then on the expenses side, again, all ordinary and necessary expenses to generate the income. Don't confuse this with paying back a loan. That's the other sort of most common mistake people make, is they think, well, I have to pay back that loan. That $100 I pay back every month is an expense. It's really not. That $100 you pay back on the loan is decreasing a liability. The expense is more for things that are used up in your operations, in your activities. So the most difficult part of setting up your accounting system relates to what's called the equity section. And the point I really want to make here about the equity section is that it ties directly to everything I said before about taxes and all those diagrams before about the different kinds of income that flows through to owners and the difference between taxable income flowing through to owners and the cash that the owners may have. That is the most difficult part of accounting. There's a reason it was difficult when I talked about it on the tax side. It's going to be even more difficult if I were to walk you through all of it on the accounting side. So what I would say for most business owners is you shouldn't have any difficulty at all managing your cash account in your bank, managing your credit card, and recording your regular income and expenses and your loan payments on your business. That part's just not hard. But you will probably need help getting that equity side right because it's directly related to the taxes. And you're probably going to need help with that tax preparation. So that's where you usually get an outside accountant, maybe a CPA, maybe an enrolled agent. And they do two things. One is they do what's called closing the books. And that means they go through at the end of the year, they check the basic accounting that you've done. And then two, they prepare the tax return after they've closed those books. So even very experienced bookkeepers usually don't know how to do that part of it. Go to the next slide. The other thing to know about setting up your systems is that even if you've been operating for a while without a good system and you've been in business, but you're just now going maybe from a manual system to an automated system, that's pretty hard to do, and that's the kind of thing that most business owners will only do once or twice in their life, so they're never going to get very good at it. It's really a good use of money to hire an outside person who does this sort of all the time and they're really good at it. Hire them to help you with that setup, with moving the numbers that you had existing on your business, moving them to the new system. That's a one-time thing. And then they can train you on how to use the new system. And that will pay off really well, because then you'll go into your new system knowing how to do it and knowing how that outside advisor wants you to do it, because they're most likely to be the person that's going to close your books at the end of the year and prepare your tax returns for you. So the more conversations you can have with them about how to do it, how to get trained in their style, that's all going to result in a cheaper bill at the end of the year when they close your books and do your tax return. So one more note on accounting setup, and this is specific to QuickBooks. If you get set up on QuickBooks, it's going to ask you what kind of a business you have, and you could say a farm or a ranch, and it will immediately say, oh, we have a default chart of accounts for a farm or a ranch. I strongly advise you not to use that default chart of accounts. It is both too detailed and not general, not specific enough. It really doesn't reflect a good knowledge of how most modern farms and ranch today's work. You would be better off manually setting up that chart of accounts, or paying someone who has expertise to set up that chart of accounts, using a combination of the categories that you find on combined the Schedule F and the Schedule C. The limitation is that the Schedule F doesn't on the face include a lot of things that are good, legitimate expense categories for farm and ranch businesses. The Schedule C has this whole list of things that are really good deductions and expenses for farmers and ranchers. But for some reason, the two forms don't, the Schedule F doesn't include these other kinds of expenses. And I'm talking about things like office expense, just really routine things, marketing expenses. It sort of anticipates the kind of farm that only makes, say, one sale a year to the grain elevator and really has no office expenses. And very few farms operate that way today. So let's just talk a bit about the kind of routine procedures that you would set up as you build your business, as you build your accounting system. So the sales cycle, this is once you're set up, right? So your chart of accounts is all set up, your QuickBooks is all set up, or your manual system is all set up. What do you do on a daily or weekly or monthly basis? Sales cycle is recording the money that comes in from your activities. So typically that means billing or invoicing for what is owed to you. And that happens when you make a sale and they don't pay you cash on the spot. They say, send me a bill. You send out that bill and you record that. At that moment, you don't have more cash, right? You have a piece of paper that says they owe you money. So what went up is that accounts receivable, that asset called accounts receivable. When they pay you, you get cash, right? And you now no longer have that piece of paper that says that they owe you money. This is what we mean by double entry accounting. Every single transaction has two sides. And you can always figure out the two sides by starting with whether or not cash changed. Right? If cash didn't change, but you're expecting some, then you're probably looking at some change to an account receivable. If cash changed, then either you made a sale on the spot, they paid you cash on the spot, so cash goes up and sales goes up, or you got cash because they paid an old debt, so cash goes up and that debt goes down. The payable cycle is the same thing, only in reverse. This is about the money coming out. So that's usually bills as they come in get recorded as accounts payable, and then payments you make as they go out decrease those accounts payable. So same thing, double entry, keep an eye on cash. Is cash going up or down? And then the other side of it is the amount you owe going up or down. Or if you're not doing it as amounts you owe, if it's just a direct payment, you go to the feed store, you buy feed. You have less cash, you have more feed. That feed is going to be gone the second the animals eat it. So that's a great example of an expense. So that's just cash paid for an expense. So you'd record that you have less cash, and you record that you have more feed expense because you bought feed. Same way you pay a veterinary bill. You pay cash on the spot to the veterinarian. You have less cash and you have more veterinary expense. Veterinary expense is a great example. That is not an asset. You can't hold it, you can't touch it, you can't feel it, you can't take a picture of it. It's gone, right? The vet came out, they looked at the animal, they maybe gave it a shot, they're gone. That's an expense. And so when you spend that money, you record both that you have less cash and that you incurred this veterinary expense to take care of the animals. Payroll cycle. I'm not going to go into any detail about payroll other than to say it's really complicated, and the best way to manage it is with a payroll service. This is sort of like I talked before about typical business owner is only going to set up a business once or twice in their life, so they never get that good at it. Payroll is something that even if you do it every week, it's still, you're never going to be as good at it as the kind of people who do payroll all day, every single day, and they've built their whole business just around doing payroll. Payroll just has a lot of different calculations, a lot of different deadlines, and in addition to the strict federal and state payroll tax reporting requirements, there's a bunch of other protective laws around employees when they have to get pay stubs, what needs to be recorded on the pay stub, what kinds of year-end reports they need to get. The rates change, and they sometimes even change mid-year. It's a lot for a business owner to keep track of. And in response to that, most payroll services, even though they seem expensive, if you really break it down, they are really good value relative to how expensive it is as an owner to dedicate all those hours to bookkeeping rather than being a manager of your business, and also relative to the cost of making mistakes. And you're likely to make mistakes. Everybody makes mistakes on payroll at some point, and usually those mistakes result in pretty steep fines and penalties. It's a fairly unsympathetic system. So if you take the long view of it, a payroll service is usually a very economical move. The only other recommendation I would make about that is that there is a payroll service that adds on to QuickBooks, and my only warning about that is that if you do it in an integrated way, it adds a lot of complexity to your underlying accounting. So I wouldn't, while I think QuickBooks is a really good system for sort of a low-cost small business management plan, the payroll service, the way that it integrates automatically, you should question, because it adds a lot of detail that isn't that useful to you. Some of the other payroll services are just as good, but they don't add that complexity to your regular accounting system. The goal here being that when you generate reports from your system, they should be fairly clean and easy to read because you're thinking like a manager. It's not helpful to have a lot of detail in your report just for the sake of having detail. And if there's any fault to these powerful systems like QuickBooks, it's that they have so much data on hand all the time that you can always generate a report that has tons and tons of detail, but that's not really the best report. From a manager's perspective, the best reports are the reports that provide meaningful summaries of information. So let's talk more about how you think as a manager about your accounting procedures. So these are the key accounting procedures that you want to be thinking about as an owner and as a manager. Reconciliations are basically a formal way of saying going back and checking your work. So the key reconciliation is a monthly bank reconciliation. Always, 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 no matter what, the minimum standard for any accounting system is monthly, proving that everything that went through your bank account was recorded in your accounting system. On the payroll side, even if with the service, you want to prove that what the payroll service reported to the IRS and what you recorded in your accounting system is exactly the same. And you don't want to wait to the end of the year to make that proof. You certainly don't want to wait 2 or 3 years out to see that there's a difference there. You want to really prove that, if not monthly, at least quarterly. And then annually, I'd talked before about, quote, closing the books. That's essentially an annual reconciliation of all the asset and liability accounts, just to make sure that you've got a handle on all the changes, you didn't make any mistakes during the year. And again, typically this is done by someone who's also going to be your tax preparer. And so they're going to look at this with an eye to mistakes that it may have been made where, for example, someone recorded income from a loan as taxable sales income as if they had made a sale, or someone recorded paying back a loan as a tax-deductible expense as if they had purchased something. So both of those things would be total errors on your tax return. But the way to find them is to have someone look at your accounting records before they start preparing the tax return and look at those records with a questioning and skeptical eye, make those corrections first into your accounting system, and then go and prepare your tax return. So again, thinking as a manager, financial statements are the way that you step back and think about the big picture. So it's best to look at your financial statements quarterly, but for sure you want to look at them at least annually as part of getting ready to file your tax returns. You should stand back and look at your financial statements, and you should know before you look at them kind of what you think you're going to see. You should know more or less if you think you have more or less cash or more or less equipment than you had last year. So then when you look at those financial statements, you can see if the numbers you now see are close to what you were expecting to see, or if they look really funny, and then you think, somebody made a mistake, I better fix that before I file my tax returns. So this is another way of talking to you as a manager and as an owner, not as someone who's overly concerned in recording every check with the maximum amount of detail. And again, these computerized systems will tempt you into thinking that you're being good because you're recording a lot of detail. That's not really the game. The game is the ability to step back and think about creating and preserving wealth. And that's about managing the balance sheet. That's about really looking at assets minus liabilities and how that equity is changing. Are you building equity over time, or are you eating up the assets that you put into the business and losing equity? That's the key question. The income statement is focused on cash on hand, annual income. Was it a, quote, good year? Do you have money in your pocket at the end of the day or the end of the week? Maybe go to the movies. That's managing for a much shorter term goal than managing for creating and preserving longer term wealth. So final thing we're going to talk about is how to get help. So a certified public accountant has a 4-year degree and a license from the state where they practice, and they have the highest level of accounting knowledge. But that doesn't mean that they know anything about farming and ranching, and it doesn't mean that they would understand issues as detailed as exempt income from certain Indian lands. So it's a great resource. They're certainly qualified to do the research and figure stuff out for you. But even at that level, you can't assume that they're expert, especially not on Indian land issues. An enrolled agent has a designation from the IRS that means that they have some expertise in taxation. They do not have the same educational or licensing requirements as a certified public accountant. They may be more knowledgeable than a certified public accountant because they may have worked in your area for a long time. So it's just a designation. It doesn't really answer the question of whether or not that person is really knowledgeable and really trustworthy. Likewise, an unlicensed accountant, similar to an enrolled agent, could be someone that's just been doing bookkeeping for a long time, could be someone who's completely expert and really, really valuable. And a bookkeeper is typically someone who is mostly focused on recording day-to-day transactions and typically does not close the books at the end of the year and typically does not prepare tax returns. So that's more the person that comes in and just writes those checks, records the bills, sends the bills out so you can get paid, maybe manages the payroll cycle. But it's the unlicensed accountant, enrolled agent, or certified public accountant that's the person that's going to be your advisor on setting up your accounting system, closing your books at the end of the year, and figuring out how to file your tax returns. For all of these people, I would say that it's difficult to find the right people, but the most important thing for you to have is trust and the ability to have an honest conversation. And probably the best way to get that is to ask through your community about who's really trustworthy and who's earned the respect of that community. So before we move on to the last two special topics, I just want to reorient and review what we've covered. So we've covered this idea of being able to break every business down into people, land, and activities, and the agreements between people forming our understanding of how entities are created, and that drives how taxes are reported and how taxes are paid. And we talked briefly about the fundamentals of setting up an accounting system to keep track of all of that. Before we go, I want to talk about two special kind of entities. These are sort of advanced topics, but they're certainly not so advanced that you won't run into them. These are concepts that are relevant to cooperatives. Aren't relevant to everybody, but they're good tools to know about. But not-for-profit and membership organizations, in almost any business that you're in, you'll have some interaction with a not-for-profit. So cooperatives are membership-owned corporations. So it's a special kind of corporation where the owners are called members, and there's a special tax section for it under Internal Revenue Code Section T, and we'll walk you through and I'll diagram why it's a little bit different of a tax beast than the other entities we looked at. And then a not-for-profit and a membership association is a special kind of corporation that does not have owners, and it's been granted tax-exempt status under the Internal Revenue Code Section 501. So cooperatives are special kinds of business organizations owned by and operated for the benefit of those using its services. The profits and earnings are distributed to the members, who are users and owners. And there's typically an elected board of directors who run the cooperative. Those could be the members as well, depending on the size. But all the members have voting power to control the basic direction of the co-op and who gets hired, for example, as a manager. Typically, members become a part of the co-op by purchasing shares. That's purchasing their ownership interest. But the amount of shares they hold doesn't affect their vote. It's still one member, one vote. Different kinds of co-ops. There's worker-owned co-ops, service or retail co-ops, housing co-ops, and the ones that are most commonly seen in agriculture are producer or marketing co-ops, where individual farms come together to have more market power, either to buy things in bulk or to sell their goods into better markets because they have higher volume. So let's break this down now, looking through the lens of people, land, and activities. So a marketing co-op is buying product from farmers who are on the land, and it has agreements with buyers who are the ones that then buy the product and go out and sell it. So all the way around you have agreements. Go to the next slide. In a co-op, the members are the owners. They make a membership investment, which is that equity section we talked about, and they participate in the profits and losses. But unlike the other entities we've talked about, they get to participate in profits and losses not based on how much equity they have in the organization, but based on how much they used or patronized the organization during the year. So you can be an owner of a co-op and not sell any product to it, and you're still an owner. And you can be an owner of a product, of a member of a co-op, and sell a bunch of farming product through the co-op in 1 year, and then you get a big patronage dividend that year, and then in another year you only sell a small amount and you only get a small patronage dividend, but your membership share never changed. Members also vote on the board of directors and other decisions. Just briefly, there's the co-op movement is big and international, and they have 7 principles that guide cooperative organizations, and it's really about the idea of democracy. This is different from other kinds of entities where you can have real differences in decision-making power between different kinds of owners. Co-ops are very much about equal ownership and democratic control. So here's the hard part. They're a little bit hard to understand from a tax perspective, but it's a good structure. The net income from a co-op can be taxed at the corporate level, or it can pass through to the owners. So it's a hybrid of the different forms we've talked about before. So in a co-op, patronage dividends, they're also called patronage refunds, that's the amount of net co-op income that the board elects to return to the members. The co-op doesn't pay taxes on any of that, as long as those dividend allocations comply with the requirements of IRS Code Section T. So like a partnership, if the taxable income goes through the co-op as a pass-through item, then the member pays tax on that item and the corporation does not. But the other side of it is that the co-op might not pass its income through to the owners, or it might not pass its income through in a way that complies with this IRS Section T. And in that case, the co-op looks like a C corporation where there's double taxation. So the income is taxed at the co-op level, and there's a dividend paid to the owner. And that dividend paid to the owner is also taxed to the owner as taxable individual income. So it's a true hybrid entity, which makes it complex. But the fact that it's a little bit extra complex from a tax perspective isn't enough reason not to think about looking into a co-op structure if there's other reasons why you think it might work for the group of people that you're working with or the purpose that you have in mind. It'll just take you a little bit more time to educate yourself until you really understand how the tax properties of the co-op work. But once you have that understanding, you may find, as many others have found, that it's actually the best entity for what you want to do. So here's a diagram, if this is helpful. So the co-op files either a 990C, that's for an ag co-op, or an 1120C, that's for other kinds of co-ops. And then it can either pass through qualifying patronage dividends, which they deduct from the corporate income, don't pay tax on, and those come to the individual owner on a 1099 PATR, that's for patronage dividend. And that gets reported on the individual owner members 1040. Where the individual owner members pay the income tax. Or the co-op can have net taxable income and not pay it out as patronage dividends, and in that case it's taxed at the corporate level. And then it may also pay some of that out to members, but in that case the members pay the tax again on that dividend income. The last topic we're going to cover is not-for-profit and membership organizations. I want to talk about these more from the perspective that any farmer and rancher should think about being a member of some nonprofit organization or membership organization that represents their interests. A lot of people talk about forming their farm or ranch activity as a nonprofit. That's a little bit of a different question. We'll talk about that a little bit. It has some complexity that goes with it. But most farmers and ranchers at some point find that there's some membership organization out there that provides valuable services to them, and so they want to become actively involved in that organization. So I'll speak to all of you as potential board members on nonprofits and membership organizations, and so you want to have some understanding of what those organizations are about. So to understand nonprofit and membership organizations, first understand that it's a type of corporation granted tax-exempt status under Internal Revenue Code Section 501. And under 501, there are 29 different types of exempt entities. So you've most likely heard about a 501c3, which is the typical charitable nonprofit. And you may have heard about a 501c4, which is a typical membership association. You probably haven't heard of the other 27 types, and you may go through happily your whole life without knowing about those other types. But there's a few of them you might want to consider. There's other kinds that have slightly different variations, and so if you ever get into the conversation about setting one of these up, you might want to take at least a quick look at a 5, 6, 7, or 8 association, which has slightly different characteristics. Here's a diagram of how a nonprofit works. So the nonprofit management and board of directors, that's the people, that's the entity that got formed, right? If maybe it's doing something, and people do form nonprofits to farm, they form nonprofits to teach farming. Sometimes they form nonprofits to grow food, to give to food banks or to communities in great need. There's lots of different ways people do it. But in that case, the landowner is still an individual. The land's probably not owned by the nonprofit. And so the nonprofit pays rent to that landowner. And then the nonprofit board of directors doesn't do the activities. They hire people to actually conduct the daily activities of the organization. And so that would be salaried payments to employees of the organization, but not to owners, because the nonprofit has no owners. What it has instead are stakeholders, and those stakeholders are going to be people who benefit from the nonprofit mission, and hopefully they're people who participate and inform the decisions of the board of directors. Where payments are made, though, it's important that everything has to be at the fair market value, and you can go to the next slide. This is the big warning about any payment coming out of a nonprofit that isn't legitimately related to the nonprofit purpose or isn't paid at fair market value. So generally, income related to the organization's exempt purpose is exempt from taxation, period. That's that. It gets reported on a 990. That's the end of the story. Net income from an unrelated business activity, and we're going to talk about the definition of that in a minute. But if the corporation, in addition to its exempt purpose, also has an unrelated business activity, that's okay, but that activity is taxed at a regular corporate rate. Big yellow arrow here in the middle of this diagram is to highlight that anyone who authorizes or receives an improper payment is subject to a 125% penalty. So that's any payment going out of the nonprofit to an individual that doesn't meet the nonprofit's exempt purpose, that wasn't directly related to the mission or directly related to the unrelated business activity, and paid as fair market compensation for rents and services. So unrelated business income, don't let it scare you. You just have to pay the tax. It doesn't mean that you lose your exempt status the minute that you have unrelated business income. It just means that you need to pay the tax because it wasn't your exempt purpose. And there's lots and lots of information on how to tell if something is unrelated business income in IRS publication 598. The scary thing, though, is what's called private inurement or an excess benefit transaction. And that is any time that an individual benefited without a true agreement for rent or for fair market wages or for value received, but some improper use of the nonprofit's resources. If that ever happens, the steps to take are, first of all, to immediately repay the amount. And there's a process for reporting the payment to the IRS if it was improperly made and paying a penalty for that improper payment. And that's where, so it's a 125% penalty, and that the 100% gets paid back. And then there's a 25% penalty that would be paid to the IRS for having made that mistake. If you admit to it all, if you immediately repay and if you report and you pay that 25% fee, you probably won't have your exempt status revoked. But the IRS has the option of revoking the exempt status if these improper payments are made and not corrected or made continually. So if you want more information on that, there's a link here to the IRS guidance on excess benefit transactions, and it's just important information for you to have, either if you're thinking about setting up an organization like this, or certainly if you're ever a board member, to be aware of where the lines are that define the activities you can and cannot do with a nonprofit. Next slide. So just another talk about where these things fit in context. They can access federal and foundation funds that for-profit organizations cannot access. So an example of that is the funds to provide educational opportunities and resources such as this series of webinars. Also a good source of funds for things like community gardens and nutrition education. Membership organizations play an important role in representing the interests of the members, and that can be advocating for changes to local, state, and federal policy. That can be at a tribal level as well, and informing members about important developments in local, state, and federal law. So not just advocating for change, but just making sure that members are aware of what the law is so they can play a really important educational role. So that's why I talk about them not so much in the idea of forming your farm or ranch under one of these, but being aware that they're an important add-on to a healthy farming and ranching environment is an active nonprofit and membership organization surrounding that and helping the farms and ranches stay current on changing law. That is it. And if we have anyone on the line that has questions at this time, otherwise maybe Janie would say goodbye and wrap us up.
Goodbye. So thanks, Bobby. That was really a lot of dense material. I know of no one better than you to actually walk us all through this, and that's why we're taping today, and so it'll be available online, archived for whoever wants to wander through it over and over and over again to get it right, because it is very dense, but it's extremely important. It's critical to building a strong food business over time, and it's one of those areas that it makes your eyes roll back in your head occasionally, but you actually do need to, have the perseverance to literally walk through it and come to understand it, and it'll help you build your business over time and have it be a strong, sustainable thing that you're involved in for you and your family. So with that, we're going to close it out, Brian, and if anyone has any questions after they actually walk through this or listen to this in the future, then reach out to us at the initiative, and we will, if we can't answer it ourselves, then we'll put Poppy on the line with you, and she's available, right?
Yes.
Yes. She's available, and she's wonderful to work with. She has a long history of working with us in Indian country, and we very much appreciate her dedicating a part of her life to making sure that tribal food production is healthy and growing strong. So anyway, thank you for taking part today, and thank you for listening in the future.
And thank you, Janie, for having me.
You're welcome. Come again.
Bye, everyone.
All right, thanks.
And I'd like to thank Poppy and Janie and remind our listeners that this webinar will be available on our website at indigenousfoodandag.com. And we invite you to go there to find out more about the Profit Series and to find links to this webinar and webinars that we've done in the past. And that will wrap us up. Thank you very much.
Thanks, Brian.